In the year 2000, Cisco Systems reported record corporate earnings. Yet, over the next 12 months, the stock lost 86% of its value. A traditional stock picker looks at a chart like that and asks, is this a good company? A big picture investor asks a completely different question first. Is this a good ocean to sail in? Even the best boat will sink if a hurricane hits the water. To read that ocean, you rely on the 3 golden rules. When the broader market is in an established uptrend, you buy strong stocks. When the trend is downward, you short weak stocks. And when the market is choppy with no definable trend, you stay in cash. Those rules operate within a strict 4-stage process. First, you monitor macro movers like earnings and Federal Reserve policy. Second, you determine the overarching market trend. Third, you select your stocks. And fourth, you execute the trade. For the rest of this lesson, we are going to assume you have already completed those first 3 stages. If you try to execute a trade without aligning it with the macro tide, or if you ignore the strict risk math of entry and exit, even a fundamentally flawless stock pick will destroy your portfolio. Arriving at stage 4 means you have a stock ready to buy. But before you commit a single dollar of capital, you have to qualify the setup to see if the math actually justifies the risk. This chart layout maps the strict 3-to-1 reward to risk rule. You must never risk $1 unless you have a realistic potential to make $3. To map this, we plot our planned entry price, our stop loss at the nearest support level, and our profit target at the nearest resistance ceiling. Next, measure the distance from your entry to your target and divide that by the distance from your entry to your stop loss. If that calculation results in a number lower than 3, you walk away. No matter how perfect the company's fundamentals look, taking on outsized risk for minimal upside is a guaranteed path to draining your account over time. Once a setup qualifies, you have to determine exactly how many shares to buy. Professionals rely on a 4-step position sizing formula to calculate a strict share limit, rather than guessing based on how much cash they have available. Step 1 is defining your total investment capital. Let's say you have $100,000. Step 2 is choosing your risk aversion percentage. For a conservative approach, we'll set this at 2%. Step 3 multiplies those 2 numbers to establish your risk capital, in this case, $2,000. This is not the total cost of your trade. This is the absolute maximum amount of money you are permitted to lose if the trade goes against you. Step 4 calculates your position risk per share. You subtract your planned stop-loss price from your entry price. If you enter at $50 and set your stop at $48, your risk is $2 per share. Finally, divide your total risk capital by your position risk per share. $2,000 divided by $2 equals a maximum purchase limit of 1,000 shares. Sizing every trade by your risk capital ensures that a completely normal string of 10% stop-loss exits will never compound into an account-destroying event. Now, test this yourself. You have $50,000 of investment capital, a 3% risk aversion, an $80 entry, and a $76 stop. Pause the video and calculate your share limit. Here is the correct math. $50,000 multiplied by 3% gives you $1,500 of risk capital. Your $80 entry minus your $76 stop equals a $4 position risk. $1,500 divided by 4 gives you a hard ceiling of 375 shares. In practice, investors rarely hold just one stock. To build a portfolio, you divide your total risk capital across a basket of positions. If your total risk capital is $2,000, a 4-stock basket means you allocate exactly $500 of risk to each individual stock. The formula remains exactly the same, but you only input that fractional amount. $500 of risk divided by a $2 position risk means you can buy 250 shares for that specific slot in the basket. If a correctly sized position fails, you trigger your stop loss and cut the trade immediately. You never attempt to average down by buying more shares to fix a losing position. Even with flawless math and a perfect setup, a trade can fall apart right at the finish line. The physical placement of your stop loss on your broker's order screen can dictate the outcome. This order screen demonstrates a common trap, placing a stop exactly on a round number like $50. Institutional computers program their trades around these obvious technical nodes, which can trigger artificial price cascades. Always set your stops slightly below round numbers, like $49.79, to avoid getting needlessly shaken out of the trade. To finalize your preparation, run every setup through this 4-point playbook. Confirm the macro trend is in your favor. Pass the stock through fundamental and technical screens. Verify a 3-to-1 reward to risk ratio. And calculate a strict share limit based on your predefined risk capital. If you enter a market without completing this exact sequence, you do not have a strategy. You only have a hope. True professionals commit capital only when the macro tide and the risk math align perfectly.